Hey guys, we're here with the Holy Macro Show. So it's interesting what's going on in the markets lately, which is, we're basically stimulating into a very strong trend. Is it a bubble? In certain areas, I think so. Is it not a bubble in other areas? Absolutely not. So it's going to be an interesting dynamic as we look at this market going forward and just see where we end up. To me, I think the writing's on the wall for what's coming down the pipe, which is probably looking at more inflation, probably looking at higher long term bond yields, maybe more suppression coming for that as well later in the cycle, possibly yield curve control, possibly like actually just announcing QE. But Ray Dalio brings up some great points in this, so we wanted to highlight this today. Kashop sent this to me and was like, "Hey, let's cover this." And I was like, "Yeah, let's do it." I think it's interesting. I think more and more people are asking me about bonds, Kashop. So that's kind of something that's been unique lately because people are asking about bonds and what goes on with the Fed and so on. So I think it's a good time to have this discussion, especially because it's such a hard subject to understand. And I don't know if it's hard as much as there's just so many different variables. You either have bond prices which move one direction, you have bond yields which move the opposite direction, you have the Fed and what they do, and they control the short end of the curve, and then you have the long end of the curve which can really do whatever it wants. So you have all of these things and all of these different dynamics. So we'll try to break some of this down today, but kind of going through what's going on with Ray Dalio, what he was talking about, and breaking this paper down because I think it was really good. So Kashab, what really stood out to you in this paper?
So the title, I mean, stimulating into a bubble, I think he nails it. Like, you don't need more words than this. So Powell came out and said they are going to end QT and start QE again because they want to grow resource along with the growth in the banking system. And that's just insane. Like, why would you want to just keep growing reserves just because the commercial banks are inflating? In fact, if the commercial banks are inflating so rapidly, you should be trying to cool it down so that you don't have a bubble in the first place. Instead, the Fed's thinking is completely backward. Look, we tightened, but the commercial banks have loosened credit, so let's just go along with them and loosen credit as well and add to the reserves in the system, which is nuts because that's what gets you high inflation. And Dalio nails it. We are stimulating into a bubble. We are stimulating into a very high inflation environment, and it is going to become sticky. And once it becomes sticky, then well, it's the only analog that Americans have is the 70s, but the Germans have the Weimar Republic, the Indians have persistent high inflation. You go to Brazil, you go to any part of Latin America, you go to Turkey, they all know what sticky inflation means and what it means for stock valuations as well. Because people think, oh, great, inflation is going to be good for stocks. I'll buy stocks and hold them and it'll work when inflation is high. Well, no, it doesn't work like that. If you go to any high inflation country, the stock market is actually a terrible place to put your money. So if the Fed keeps stimulating into a bubble, the US is going to become like that.
Yeah, no, I agree, and I think it's just, the interesting thing to me in the paper was, and what you said is perfect because I think, a lot of people don't understand what inflation means in some of these countries, and they might say, "Oh, that only happens in small countries," and so on. It's happens in some big countries as well over time. Not to mention what you said about stocks, like, yes, if you look at, the Venezuelan stock market, which is if you're looking at the index, it's priced in their currency. If it's priced in their currency, yeah, I'm sure it looks really good. Priced in dollars looks a lot differently. So, understanding these dynamics as a trader, it's kind of like understanding. I always talk about the different types of trading, and one of those types of trading is structure. Understanding the structure of these markets, of what you're trading. If you're trading an ETF in the United States, you're going to have the dollar become a massive indicator of what's going to happen with that, as well as if you're trading, the index in futures, you can get exposure to any of these countries, Brazil, India, and so on. And you'll see that, the charts almost look great. They look in these amazing uptrends, they never go down. But it's really because the currency is depreciating at such a fast rate that the stock market's going up. So is it better than holding the currency, to hold the stocks in that currency? Yes, but at the same time, are you actually making money? And the answer is no. Because if you're pricing it in US dollars, you're basically would be you'd actually make more money holding the US dollar over that period of time. And we're talking about this going forward. So this could be a situation that starts to happen in other areas, including in the United States. So, what really stood out to me is the idea that we announced the end of QT and we're beginning QE is what Ray Dalio is talking about. And the way he breaks it down is perfect. Like he kind of talks about the fact that we're going to be doing this, but they're also started talking about the facts of adding reserves. So they're adding reserves to the market, which means that they're also doing a form of quantitative easing. I think we used to call it back in the 2010s stealth QE. So I think we're kind of in that period of time where we're going to see more moves like this, and what he kind of highlights is that stocks are near all-time highs, credit spreads are near all-time lows, unemployment is low historically, inflation is still above target, fiscal deficits are massive, and AI stocks are in a bubble. And so these are the things that he's kind of talking about in this that says like, hey, why are we cutting rates? And once again, like you guys all know this by just following us over the time. Like we've been talking about how crazy this is for a while. Like, if you were going to say like what were the like once again, I don't care what they're doing. I can't change what the Fed does, but I can position myself properly for it. But if I'm looking at it just from a perspective of when would the Fed start to cut rates? Well, I would see, stress in the credit spreads. I would see stress in the stock market. I would see more stress in the unemployment rate. I would see inflation below target. Like they keep saying, we remain we're looking for that 2% target still in inflation rates in the United States, and that's bullshit. I mean, we all know that. But they keep saying that, and so we're way above target on inflation. Inflation's actually been moving up higher this year. So once again, we're just looking at all of these things. Fiscal deficits are massive. AI stocks, you could say they're in a bubble. I think the Mag 7 possibly is in a bubble, and there's other areas that are not, but that's any market. But if you look at the overall valuation of the market, if you're a fundamental person, like, yeah, you could say it's in a bubble. So all these reasons are saying like we're easing into something that doesn't really make sense right now. And usually that leads to other things happening, like more inflation, like the stock market actually having some problems. So, Kashab, what do you think about that? Do you think we're in a position here where, we're going to end up in this massive inflationary cycle? And do you think it's for these reasons that Dalio is laying out here?
Yes, and it's an unqualified yes. I think that's exactly where we are heading, and I don't see a way that this can be stopped. And the reason it can't be stopped is because nobody wants to. Nobody wants to because, well, that's the system. You have such a massive debt bubble. You have a sort of an implosion in the private credit market right now. And the Fed's answer has always been whatever the problem, let's print more money. There's an invisible enemy you can't see, which is COVID, let's print money. There's
Yep.
9/11 attack, what do? Let's print money. So there is low inflation, and that was because they had low interest rates for a long time and they were measuring inflation wrong. There is low inflation. What is the solution? Let's do more QE. So the solution is always let's print more money. And now fiscal is also driving it along with monetary. So that's something that we are going to get into later on in the show. So I think it's just going to be an endless credit wave. Now, the problem with these endless credit waves is that you can't exactly say let's be long everything and we'll make money, because there are so many distortions in the marketplace. There are so many malinvestments that you never know exactly how it will play out. So for instance, low interest rates in the last decade gave rise to your VC boom, your DoorDash, and all your apps, all your Ubers and social media, everything. So they all grew in a low interest environment, and then they made money in a high interest environment. And now what's going to happen? Nobody knows. Like, are you going to see price hikes across the board? Are you going to see more of private equity money going into subsidizing, for instance, your burritos, like you're getting burrito loans, which is kind of becoming a meme night right now. So are you going to see more credit go into lowering consumer prices this way because the VCs take the hit, or are the VCs going to go broke and therefore you're going to see soaring high prices on everything that was VC subsidized? We don't know. So we don't know exactly the direction that inflation will take, and that is why we don't know exactly the direction asset prices will take. And I mean, if we knew that, then great, but we don't really know that. So situation like, let's say, Fartcoin, it came up when rates were at 4%. So is that even something you would have imagined possible? Rates are so high and people are speculating on meme coins? Not really. Now you could have an environment where the Fed cuts rates to zero, but people become risk averse. So this is what Keynes called animal spirits. So the Fed can stimulate animal spirits, but at some point the cycles will just get more brutal and you may not be able to. So this is what we saw in Japan. So I don't think we're going to a Japanese style deflation. I think they'll just keep printing money and we'll have higher and higher inflation. But it's going to be, the waves are going to be tougher to ride because you're going to have higher peaks and higher valleys, and the gaps between the peaks and valleys are going to keep increasing.
Yeah, I think when we look at this, it's a, when we're in this, like, Paul Tudor Jones talked about the 1999 scenario, and even Dalio talks about that a little bit in here. We're closer to a 1999 scenario, and what he means by that is that this market could just melt up for a while. Be kind of insane, kind of crazy, like it has been, but also it could crash at some point after that. And what happened in 99 is interesting because a lot of people don't know what happened to the market at that point. A lot of people, like, once again, it's years ago, so people didn't study it. So people just look at it and go, okay, the market crashed, everything went down, recession, and so on. And they don't really realize, like, actually, a lot of things did really well during that time. Energy stocks started to bottom out and move higher. That was 99 when you had the oil go under $10 a barrel. It was the end of oil. I think there was a bunch of magazine articles and news articles saying it was the end of oil. Oil bottoms out right there, and then the energy stocks start to catch up with it. They bottom out as well. Gold was already leading the way. Gold starts to make that move. I think it was the end of 99 into 2000. Gold starts to bottom out, starts to trend higher. Copper starts to move. But then also, like, people forget about the stock market, and microcap stocks started to do really well. Small cap names started to do really well. Basically, anything outside of technology, even the financials, started to do well and held up. If you look at a chart, I think it's I'm just doing this off the top of my head, but I think it's Dow Jones. I think if you look at the Dow compared to the Nasdaq or compared to the S&P 500, the Dow barely went down. Like, it kind of goes sideways and chops around a bit. Like, yes, it's not like raging, but it's not getting hit the same way that these markets, especially the indexes that were so heavily weighted in technology, got hit. So I think that's kind of the scenario that we're looking for here too, which is, yeah, like, there are some things that are looking pretty bubblicious, but there's also a lot of areas that are not. The miners, like, looking at the copper mining space, like, people forget, like, they're like, oh man, these runs are crazy, gold miners are up 110% or 130% or whatever. It's like, well, these things haven't moved for years. Like, go back to 2011 is the last time gold miners really moved. Go back to 2008, the metals and mining sector just is getting above those highs right now. That's XME. Copper miners, they haven't made a new high since 2011. That's the global copper miners too. So, like, look at these things and understand, like, these things might just be getting started. Same thing with energy. Energy made a new high. I think it was 2016, 2015. It just hung around that 101 zone. And then it's basically, I mean, even since 2008, it's really been sideways. Like, it barely made a new high in 2016. And then it went sideways ever since. Like, these breakouts could last for a long time, and money could rotate from, things that are overvalued to undervalued pretty easily. This is what happens. Like, everybody looks at this and they go, this whole valuation thing doesn't even make sense. AI is going to do this, and all these years later, value has sucked. And I'm not saying, like, value is going to take over the world once again. But what I am saying is like money rotates. Money isn't going to just stay in AI stocks forever. Like people are like, "Oh my god, the internet, the 90s." Talk about the 90s and you have this massive dot-com bubble and the internet's changing the world and it really did. However, it didn't mean the stocks went in a straight up and down line. They also went up. They had that huge move in the 90s. They went nowhere until I think it was 2013, 2014 for the breakout. So like we literally like have to pay attention to these things a little bit more because I think so many people kind of get it in their head that the market has to be this orderly thing, or it has to, these things that are the biggest stocks in the United States will always be the biggest stocks. And it's like, no, it's more dynamic than that. Things move and change. ExxonMobil was the biggest stock for many years, decades. Now I think it's number 20 in market cap. That could change, and ExxonMobil could take back over once again. So it's just really an interesting time to just kind of understand what happened in the 90s and 2000s and kind of understand where we're at today, because there's different sort of crashes. There's deflationary crashes, let's say 2020, 2008, short term in 2020, very short term deflationary shock. 2008 is another one. And then there's the 2000 crash, which is more of an inflationary crash. We started to see all these assets start to move after that. So I think it's a really interesting time to really pay attention to things like this. A lot of people look at Ray Dalio and they go, "Man, this dude's crazy. He's just always, trying to scare everybody and so on." And yeah, he has a lot of like books like that, but I will always read his stuff because one, Ray Dalio is, if I think of somebody, and Kashop and I were just talking about this before, if I think about somebody who really understands how to tie in monetary policy, bonds, and what it's going to do to the stock market and the economy, there's nobody better. Yes, I really like, a lot of the Austrian writers and so on, the Austrian economists, they do a great job. But like, how do you tie that into markets? Economists aren't very good at tying things into markets ever. But Ray Dalio does, because that's actually what he does. So, hopping into this one, Kashop, what are you seeing here? He's talking about the stimulus episodes, where we're at, the starting points, what happened to GDP, unemployment rate, inflation. So, can you explain to the audience what exactly he was talking about here?
So, on your point on Ray Dalio, like people always saying that he talks like he's a perma bear. Well, the thing is, if you are in the markets long enough, you kind of tend to focus on the negatives. And once you study history, like what he's talking about, once you study history, once you study what markets have done when things have gone wrong, like wrong in the sense, you have these wars, you have these big events. So when you study what happens at those points, it is hard not to let that cloud your bias. I mean, the perfect optimist is the guy who just goes 100x leverage long Bitcoin and doesn't care about risk, right? But that guy doesn't last long in the market. Now, the more you become attuned to risk, the more you will become like Ray Dalio. So that is just the way it is. And I don't know how to explain this table right here. So if you can, I think you'll do a better job of it than me. I'll leave
Yeah,
it to you.
Yeah, I mean, what he's looking at is a different stimulus episodes, so we're looking at like, what happens during these times to the GDP, the unemployment rate, inflation, the debt to GDP ratio, and what happened to the markets afterwards is what he's talking about in his paper. And, some of these are crises that happen, and when we're cutting and we're easing into these crises, it makes some sense. Sometimes it doesn't. And the ones that don't make sense usually turn into a really crazy speculative bubble that ends in a type of crash or a big rotation. And what he's looking at is that thinking that most of this is going to end up in a rotation into real assets, which I think is spot on, and something you and I have been talking about this whole time, which is like the way the market is set up. Like not every time, like Kashop and I aren't going to get on here every time and go, "Hey guys, we're going to be in a massive crash and this is all going to happen." And we're talking about this in different ways. One is like people think like, we talk and sometimes we're bearish on technology or this, like what we're saying is like there's a rotation. And so sometimes these crashes lead to rotations. Great Depression crash. You're talking about a deflationary shock, which led to a lot of inflation. You basically turned in 1933. You have the gold seizure. They're able to devalue the dollar a bit more because of that. And next thing you know, you have some form of easing. You start to see a different type of environment. Gold miners back then actually did really, really well. You get to the great financial crisis, same type of scenario. You have a deflationary shock, and then you have a lot of easing, and it leads to another move in things like gold miners and so on. Everybody remembers a big run that happened in 2009 all the way to 2011. So, when you're looking at these things, you have to understand the differences in the crashes. COVID's another one. We had a great, huge deflationary shock. Fed eased as much as possible, cut rates to zero, said unlimited quantitative easing, and then next thing you know, we run into this big run in gold, the commodities, and so on. Gold made a run into August of 2020, and then after that, the rest of the commodities really took over. You had oil, you had sugar. You basically, I always make a joke, like, because people are like, "Oh man, your returns were so good back then." Like that was an insane year for you, and I'm like, it was an insane year, but I could have spun around and threw a dart at a commodity and just bought it that year and made money. So like, yeah, I did well, and I risk managed well, and I know how to ride trends well. But however, like the market was just screaming higher in the commodity space. So now we're in kind of a similar scenario. We're not in a crisis per se, but we are seeing like something that's very overvalued, somewhere that is way undervalued. It could be value stocks, it could be energy stocks, it could be bank stock. I mean, really, value stocks are energy stocks for the most part. If you look at the indexes, not saying like what Kashop finds value in, saying like the index wise, there's a lot of energy and bank stocks in the value stocks space. So looking at that, I do think there's this big rotation building under the surface. I think we've already seen some of it starting already if we're just looking at the gold miners, if we're looking at the copper miners. So I think that's going to continue. And I think this chart just kind of says the type of scenario that we're in today, which is a little bit different. We're not in a scenario where the market is crashing, which is also part of the reason why Ray Dalio is even more concerned about the situation. But I just think for me, I don't know when something's going to crash. I'm never going to fade an uptrend, and AI and technology is in an uptrend. But I can say there's a lot of areas that look great and like they're going to produce some insane returns going forward. And I think most of the investors right now are overlooking it. So we could go to either one of these, Shop. Do you want to talk about this one or the
Sure,
next one?
sure. The next one. So yeah, I mean, both are telling you the same story. So
Mhm.
the Fed started hiking rates on March 16, 2022. So that's when they announced their first rate hike. And if you look at what's happened to the money supply since then, so you can see there was a clear downtrend all the way until the collapse of Silicon Valley Bank. That's when they introduced the bank term funding program, and the Treasury and Fed just went all out to contain the regional banking crisis, and the money supply has been rising ever since. Now, this is the story that they haven't told, because only now the Fed is talking about ending quantitative tightening. But if you actually look at the money supply, and I'm using M2 because it is not as narrow as M1, nor is it as broad as M3. So instead of M3, we'll be using a different chart in the next slide. So this tells you that whatever they've been talking about tightening, it's like, what tightening? Yeah, you got a tightening in 2022. Stocks had a tantrum. They went down massively, and then boom, it's back up again. Money supply is up. The AI bubble got going, and that's really the thing. So next time the money supply goes up, the bubble might not be in AI. It might be in something completely different. Like if you go back to 2021, the 2020-21 bull market where Jason was talking about, you could throw a dart at a commodity and you will make money. So that was a commodity bull market. That was a crypto bull market. Tech did okay, not great, not bad. It just did okay. Like if you line up the returns on tech compared to say, what was your best trade? Canola, lumber. If you line it
That
up,
that year,
yeah.
I couldn't, but you're right, which is I think technology, had a underperforming year, like between 10-15%. I can't remember the exact number, but like if you look at like energy, I can't remember the exact number either. I'm sure Wavy probably has it off the top of his head. So if anybody knows what year to date 2021 energy did or year to date 2021 financials did, you saw a lot of those have massive outperformance compared to technology. And really tech or energy really outperformed that from I want to say November 2020 all the way through 2022 into 23. So you had this massive performance in these areas. I think even in 2022 energy was still up 50%. So you have this massive outperformance. You have these areas where you could go, but you guys have heard me tell the story before, but if anybody didn't hear this before, which is I'm sitting down, it was the end of 2021, and I'm out to eat with where I'm out to eat with a bunch of investors, a bunch of fund managers, and we're all sitting there, and everybody's kind of depressed, and I don't know what's wrong with everybody. And then they're all kind of talking about how they had a tough year and it was so hard to trade in 21, and I'm sitting over there going like, what the hell are you guys talking about? Like this is like you could have bought a ton of things this year and they all did a lot of made a lot of money. And like I'm talking about people who say like they're technicians and they buy relative strength. Like if you're a relative strength sector trader, like you'll see that there's lots of different things to buy. You could have bought energy that year. You could have bought small caps that year, micro caps that year. I think China did that well that year. Like a lot of things did really well in 2021. Commodities, not even to mention commodities. But also, they were so stuck. And what they said is they're so stuck on like the technology trade because they've been doing it for so long. It's been working so well for so long that they couldn't rotate into anything else. And so the biggest thing here isn't saying like I know technology is going to go down. It's the fact that there's better places to be that are going to have more outperformance. And I don't know what the future looks like, but I am telling you, when you see relative strength to something like, if everybody's looking at XLK and they're going, man, XLK is the best spider sector. And then you see something like GDX and you go, well, that's extended. And, it's up 110%, that's extended. And then if you look at COPEX and you go, well, 70%, that's extended as well. I don't think I want to own that. However, you're happy to own technology stocks forever and ever. Like that's where, your logic gets messed up. So mainly what I'm saying here is just understand markets rotate, things will change, and that's okay. And as a trader, like you have to be interested in that because if your goal is to make money, like there's gonna be times you're gonna be like, hey, I love China. China's the best place to be. Latin America, very interesting. Now I'm gonna look at this other area in Europe, interesting. It's not that I love Europe. It's not that I think anything good of any of these countries. It's that I see where money's rotating and I'm going to focus on these areas. And remember, this is what we're talking about here today is the movement possibly out of technology. And if we're moving out of technology, these other countries, like they have industrials, they don't have technology companies. They have bank stocks. They don't have technology companies. They have energy stocks. They do not have technology companies. Some of these countries have zero technology. And that's very normal for some of these emerging markets. So if they're going to be outperforming and you want to find some diversification out of technology, not saying to sell every technology stock you have, I still have some semiconductors and so on, but at the same time it's a you want to rotate into some of these areas where we're seeing strength, we're seeing some momentum, and not to mention there's the possibility that things rotate very heavily from technology into some of these other things or growth to value, however you want to look at it. So I think these are things you have to look at, and understanding the money supply is going to be very important, all these things as well.
So, as Wavy says, in 2021, energy was up 53% and financials was 33%, which is massive when you consider that these are the indices, these are not individual stocks. So, individual stocks, you found much bigger moves. And that's really the point. So, right now, we had this big bull market and bubble in AI. It was not necessarily true that the last time Fed printed, we had a similar bubble in tech. It wasn't. And it is not necessarily true that the next time, the like right now, when the Fed starts stimulating into a bubble, the bull market will continue in tech. It may go into completely something very different, you know. For instance, it could be, I don't know, platinum, palladium, just pick any other commodity which no one talks about, like, you know, maybe it's even cocoa. You never know where the money goes, or palm oil. You never know. You just never know where the money goes to. So that really is what makes it hard to ride these inflationary cycles. So, can you go to the next slide? Yeah, so we get into this interesting debate about whether there are these two schools of thought. One is that, or rather, three schools of thought. So you look at the Austrian school, they define inflation very simply, and inflation is just increase in the supply of money. Now, that's helpful in terms of understanding what the market is, in terms of what the business cycle is, in terms of understanding ground up economics. But if you're a trader, if you're a financial market participant, that doesn't really tell you anything, because the Austrian school is not about prediction. It is about explaining the world as it is. It's a framework. So when you want to get into predictions, when you want to get into trying to understand how the future will unfold, then we have to go to the Chicago school, the other economists, the other people who are doing empirical studies or statistical studies. So here there are two schools of thought. One is the Milton Friedman school, which says inflation is always and everywhere a monetary phenomena. And then you have this other school which talks about fiscal dominance, where they say high inflation is always about it's always a fiscal phenomena, meaning it's always driven by the government. So when the government wants to raise its debt, that's when inflation raises head. So if you look at what's happening with the federal debt right now, it clearly tells you that something is breaking. So it tells you that inflation is here to stay, mainly because this debt, it's increasing at a rate of around 2 trillion a year, and at 4% the servicing cost on this debt is getting extremely high, and there is no will to even rein in the deficit. In fact, the deficit is also going to increase to kingdom come. So when you look at a scenario like this, what does it tell you? It tells you that maybe inflation is driven by not just the Fed money printing, but by the government as well, meaning that maybe it's about inflation, fiscal dominance as well. So, Jason, I want to get your thoughts on that. Like, let's put up the two camps and talk about it.
The differences between them?
Yeah.
Yeah, I think like one, it's a Austrians, I think, have it right, like because if you look at the idea of inflation and money supply, it's like it's very simple. But like the more complex you make it, and the more you try to get into like, well, it could do that. Like think about it going back to, everybody was like, see, the Austrians are dumb in 2008. We had quantitative easing, and basically it was completely right until 2011 happened. So 2011 happened. Next thing you know, gold started moving down. The rest of the commodities complex started moving lower. And everybody said, look, quantitative easing doesn't create inflation. However, the stock market just rallied and rallied and rallied. And I mean, we had probably one of the biggest, I'm sure it's monetarily the biggest move that ever happened in stock market history. I'm not sure about percentage gains, but it's the biggest move from basically 2009, the March bottom, all the way to where we're at today. I mean, even the pullbacks are shallow and small. Like we have these V bottoms that continue to happen. I think we had a small consolidation period. I want to say that was 2015 through 2016, the industrial recession that happened in the United States. That's a very small consolidation period. Then we go right back up again. So why is that happening? Well, it's because we have this very loose monetary policy, and we had rates at zero, and we did QE1, QE2, QE 1 million, like we continue to do stealth QE at certain points, or rescue the repo market, or whatever we had to do to keep the market going up. So I think that's always a very significant thing that we have to pay attention to. Um, so, but yeah, so let's hop to the next one. So, got these two quotes from Milton Friedman and Thomas Sargent. So, what are we looking at here, Kashab?
So I think they're both right in that time, meaning Milton Friedman was right. So if you go back to say the 60s, 70s, or even the 80s, so the federal debt crossed 1 trillion for the first time somewhere in the 1980s. So until then, the government wasn't that big a part of the economy. In fact, you look at any movie, you find, I mean, like you look at all the old mafia movies, for instance, they talk about how the FBI had to kind of case out, the criminals joints, like from outside they couldn't really get in because you had lawyers going over all your civil rights issues. And now the government is so big, they can just do a SWAT raid straight into your home, no questions asked, no knocks, and nobody can even question anything. So the government has become a big part of people's life, not just in terms of the financial part of it, but in terms of everything. So it's everywhere. So when Milton Friedman said that inflation is always and everywhere a monetary phenomena and it's purely central bank driven, he was right, because at that point it really was. It wasn't about the governments, but it was about the central banks printing the money supply. So you go to everywhere from the South Sea bubble to John Law to the Bank of England to every episode of monetary debasement, continental dollars. Everywhere you look at it, it was always the central banks which were doing the money printing. Sorry, not continental dollars. That was the government, but everything else. But now, if you go into the present century, especially since 2000, especially since Greenspan, the maestro who was supposed to be so great at controlling the economy, especially in this time, it is kind of government driven. And it is government driven because, well, the central bank eventually has to inflate to keep up with the debt, and they have to keep up with the debt because if you don't, then you have a deflationary crash. And the worst thing that, to the central bankers eyes, deflation is always worse than inflation. So Ben Bernanke wrote a paper where he got the nickname Helicopter Ben because he said, if there is ever deflation, we will go physically drop piles of cash from helicopters over New York so that the deflation problem gets solved. And that's how they think about it. So when you have an environment like this, or even take 2020, where it was straight stimulus checks to every American. Why? Because that is just the way the government functions right now. And when you have these camps where they say that, why do you even need taxes when the central bank can just print money? Meaning you just integrate the central banking function with the government function. So in this camp, I think persistent high inflation is always and everywhere a fiscal phenomena, in the sense that the Fed has to print in order to keep up with the government spending and the deficits. Because if they don't, then they generate deflation, which they hate more, and therefore they will print. Which means if the government forces the Fed to print by running record deficits and increasing the debt, then they will eventually print, because it's the government is pulling the central bank in that direction. And no government will ever say, hey, we are going to cut down spending, we are going to trim parts of the government so that we spend less. No one's ever going to say that. So in this situation, I think fiscal dominance is the right theory. Although I'm not saying Friedman is wrong, I just think that we have moved to a different scenario right now, and it's good to acknowledge that. Now, if you look at the deposit growth in the commercial banking system, so that also makes my point, because right now what the Fed is saying is that the commercial bank is expanding, commercial banks, the banking system, they are expanding credit, we are not. And instead of telling them to cut down, we are just going to increase our reserves to keep up with the banking system. Now, why is the banking system expanding credit? Well, because it has to buy all those treasuries, they have to fund the US government, they have to fund private credit, they have to pretty much fund everyone who needs funding. So especially the big private credit market. So, and of course the 2 trillion a year in deficit. So at that point, deposits in the banking system keep growing, and the Fed is like, yeah, we are just going to increase our reserves so that we can keep up with this. So this is where I think the fiscal dominance comes in, and the central bank is being pulled to increase credit in order to keep up with the supply, that the money supply increase that is being driven by government spending. It's being driven by the deficit spending.
Yeah, I think it's really interesting because there's always been this like, oh my god, they're talking about the debt, like feeling of market participants. And now once again, like it matters because at a certain point you do hit a point where there's no going back. Like Debt does matter. And the only way to really make it go back down is inflation. Which is the reason why like they say things like you just said, like, or they're going to drop money out of helicopters if we have deflation. Like, why would they do that? Well, it's because the amount of debt we have, we can't have deflation. If the dollar got too strong, that would put way too much pressure on everything. The global economy is, and our economy as well. A lot of people don't think about that, and so it's the reason why, like, you have somebody like Victor Sprandio. If you go back to, if you're on my channel, I think it's the featured video still, but it's Victor Sprandio. But he talks about the fact that we might have hyperinflation at some point in the United States. And people go, that's crazy. There's no way to have hyperinflation in the United States. It's the United States. We're, the biggest country in the world and the strongest and this and that and the other thing. It's like, well, if we need to get rid of the debt, and this was his point, if we need to get rid of the debt, we need to get it down quickly. We could get rid of it with 50% inflation per month for 6 months. And he said most people could deal with just about anything for 6 months. He said, so I don't know if that's off the table, but he said that that's a possibility. And so, like, I think that's something to keep in mind here. And it wouldn't be that insane. Like, I think a lot of people are looking at it and going, like, when you talk about debt and you talk about inflation, like, this is impossible. This can't happen. However, if you look at it from that aspect, it's like it might have to happen in some way. It's the reason why they don't say our inflation for normal people, their inflation target would be much better at zero. If they say they're doing this for the people and it's for the jobs, and they're trying to make sure we have no inflation and enough jobs and all these things, why don't they have a 0% target for inflation? The answer is they can't. They can't because of the debt. The debt, the only way you pay off the debt is with more inflation over time. So I think that that's just what we're going to see. I think even though, like, the general plan is they keep talking about less inflation and controlling inflation. I think it's also they want inflation to some aspect. They just don't want it to get out of control to the point where people start going, "What the hell is this?" Like, people start revolting over it. So that's my thoughts on it. What do you think about that, Kashop?
So, to Victor Spirandio's point, I think, so to me, the difference between inflation and hyperinflation is this. Inflation is fiscal dominance. Inflation is central banks printing money. So that it's always going to be a part of our life. The difference in terms of when it becomes hyperinflationary is when people lose confidence in the currency. So the phrase not worth a continental, it comes from the fact that people lost confidence in the continental currency because they knew they were going to lose the war. Now, every time there is a war, in fact, the losing country's currency, it depreciates. And that's because they issue war bonds, they take credit in other forms, and they know that not only can they not pay that back, but they are going to have to pay war repatriation. So everyone talks about Weimar Germany, but why did the Weimar Germany hyperinflation happen? It happened because they had to pay back those war debts, and they couldn't pay back those war debts. So what did they do? They inflated the money supply. Now, that led to all sorts of other problems, and eventually you had a hyperinflationary collapse. So every time you have this debt problem, every time you have this issue which spooks investors and they lose confidence in the currency, that's when you get hyperinflation. Now, how it starts, nobody knows, because all fiat currencies have died and they have all died their own unique death. So we don't really know what will cause hyperinflation. All we know is that once it starts, it ends with the complete destruction of the currency. And we have seen this in our lifetimes. We have seen this in Lebanon, we have seen this in Zimbabwe, we have seen this in Argentina. I don't know what other countries I'm missing. Venezuela, we have seen this play out so many times, and mostly it comes with regime change and it comes with massive amounts of debt. So the scary thing is massive amounts of debt that's perennial in the system, regime change, unpredictable. So whenever it happens, you can easily make the switch from just inflation to hyperinflation. And The only way to protect against this is to be constantly watching for these signs. So watch for the signs of regime change, and I think that's really all we can do. And of course, you buy gold and silver because those can never be devalued, and that way, whatever happens, you're safe. But as market participants, the best thing to do is just to be vigilant and just to make sure that you are aware of under what conditions things can go wrong so that you avoid those conditions altogether or you prepare for those conditions, because you can't really hedge these risks. You can't really say I'm going to buy these options and it'll protect me from hyperinflation or 30% inflation rates. Like, you can't do that. All you can do is be aware of the regime you are in, constantly update your macro, and make sure that however the market changes, however the macro environment changes, you are ready for it.
No, totally agree. Well said. So we'll get to some questions now. I got a couple from people. If you guys have any more, drop them in. I've only got 10 minutes, so we'll try to fire through these. Aside from the usual factors like fiscally responsible government, great demographics, growing profits, etc., what other factors can one consider that are often overlooked when investing in emerging markets? So I could start this off. So, looking at this, okay. So we'll get to what I do and then we'll get to what Kashop does because I'm sure they're two totally different approaches. Looking at emerging markets, what I do is I look at the currency, I look at the central banks. What are they doing? Are they inflating? Are they trying to deflate? Are they trying to strengthen their currencies and so on? Besides that, then I look at the currency on the chart. Is the currency in a straight downtrend? I'm probably not going to be buying an ETF in a country with terrible currency most of the time. Once in a while, sure, but most of the time I try to stay away from those. But I think the thing that's overlooked the most, which is the dollar. Like if you're seeing the dollar, like everybody looks at the dollar. I mean, I had a conversation with somebody the other day and they were like, the dollar index is only these four, or five. I can't remember how many countries are in there at the moment, but it's only these currencies. So therefore, we don't have to worry about these other countries as opposed to what's going on in the dollar. And it's like, well, you could think that, but also like, how do people? What is the dollar? Well, it's the world's reserve currency. What does it matter to them? It matters a lot to them for trade. And a lot of these countries live on trade. If you're looking at Brazil, like why is China going to probably buy more from Brazil than they would from the United States? Like, yes, they could be bullied into buying something or say some agreement or just tell us they're going to do things. But in the end, it makes more sense for them if they're going to buy soybeans, buy it from Brazil. The currency is cheaper. The trade rates are going to be cheaper. They're going to be easier it's going to be cheaper to get a lot more goods from them instead of trying to get it from the United States with a much stronger currency. So this is the part of the reason why I talked about the dollar being so important to all of these things. A strong dollar isn't great for a lot of things. It's certainly not great for trade, especially where we're at currently with all the countries basically trying to devalue. Everybody's trying to devalue at the same time. And so that doesn't turn into a scenario where we go, okay, well, we're definitely going to, buy a lot more from the United States. Think people generally all over the world are looking at different ways to do that. But if I'm looking at emerging markets, like I'm really like the two factors. If I was just going to take two things and say, hey, only look at these two things and you will do well investing in emerging markets. One is I don't know enough about the individual stocks in some of these countries to go through all of them. Some countries I do, some countries I stay away from. Some countries I'll send Kashop a message. Hey, what's this gold miner in this country? Like what am I looking for? What's the things that could go wrong in this specific country? Because that's what he does really well. And so, sometimes I'll stay away from the individual stocks and I'll buy the ETFs in these countries. And I think that's an easy way to do it with a little bit of diversification. They're not as heavily weighted like the United States, like we have tons of stocks in all these. Most of these countries, they're heavily weighted in only a few names. So you do get that outperformance with a little bit of diversification. So the two things I would look at is the dollar and then looking at the price action. For me, it's if the dollar's weakening or in some sort of structural primary downtrend, which it is today. Yes, everybody, you can write me and tell me about how it's bottoming out or whatever. I'm just here to say, like the primary downtrend, however you look at it, Yes, there's going to be bounces. There's going to be, it's like looking at something in an uptrend. You look at Nvidia in an uptrend and you'd say it's in an uptrend, and every pullback you would just want to buy it. It's the same thing with the dollar. Like now it's in a downtrend. Like every move that's moving higher, unless it structurally changes trend, is probably an opportunity to short it once again. So I'd look at the dollar, it's from primary downtrend, and then I would look at the price action of each of these countries. I would try to find relative strength. Where's the relative strength living? Right now, it's in Asia. You know, if you look at South Korea, it's starting to show up in Latin America. I really like the Latin American trade at the moment. So looking at the relative strength, like what's performing best, and then start to figure out where you want to be from there. You could look at it, and you got to identify time frames. You know, however you trade, like a 1 month time frame might tell you, hey, Saudi Arabia is starting to look good again. Another one, a 1 month time frame, told me recently Argentina is starting to outperform again. So we start to see things like that. I'll get into these trades. So a couple things to look at is the dollar, relative strength, and then the charts. So Kashap, you go ahead.
So George Soros said that the best time to invest in emerging markets is when conditions go from extremely terrible to slightly less terrible. So I think that's your first filter. So you looked at bombed out markets, Greece, Cyprus, Turkey, Argentina before Millet. So you look at bombed out markets, or Peru when they keep going through those elections and changes. So you looked at bombed out markets and you think, okay, maybe now this is interesting, because all you really need is for sentiment to turn just a little bit in the other direction. So little bit of despair turning into hope is all you need. And the second thing, which is a hard indicator, is you look at the banks. Because if you want to know how a country is doing, look at how the top banks are doing. Are they lending more freely? Are they saying that their customers are doing better? Are they seeing signs of credit distress? Now, it's very hard to find out whether banks are seeing signs of credit distress because they won't tell you. But if you look at the bank balance sheet and you look at them quarter over quarter, and if you see that they are curtailing lending, then you know that there is credit distress. And if you see that they are expanding lending, if you see consumer loans becoming a bigger part of their balance sheet compared to industrial and asset backed loans, then you know that the economy is expanding. So in those conditions, you buy those emerging markets. Now they will have a host of other problems. So classic example here is India, which I'm more familiar with. So India is going through a massive inflationary boom, and the currency is kind of in a horrible situation, and the country has capital controls, and you have all these hosts of problems. So you talk to anyone in India and they'll tell you they are really suffering, that they have all these issues, and the government doesn't care, like blah blah blah. All of these things are true, but then you look at bank stocks, they are making highs. You look at consumer credit, it is growing like crazy. You look at asset prices, it's booming like crazy. Now, what this means is that banks are in an expanding cycle, which means the stocks in that country will do well. It's a very simple filter. Now, the other filter, which I said about sentiment, doesn't really apply to India because everyone is bullish India, but that's really the tough thing to balance. So, you take a look at, say, Vietnam or Poland. Nobody cares. But are the banks lending? I don't really know, but it doesn't, they're not in an inflationary boom. So would you still buy that? Yes, because the sentiment indicator says that you should buy them. So it's really tricky to buy emerging market stocks, but I think banks and sentiment, those are the best ways to filter it down.
Awesome. So we got to end it there, guys. Thank you guys so much for coming and hanging out with us. This was a really fun show. I hope it was informative for people. Definitely check out Ray Dalio's letter. It's on LinkedIn right now to learn a little bit more about what we were talking about here today. And we'll see you guys next week at 10 a.m. on Fridays. See you then.
Bye, everyone.